Alrighty. Looks like NASDAQ market is selling off right before the live stream actually starts. So Jerome Powell, who is the head of the Federal Reserve, is going to be speaking today. Let's see it.
Okay, why don't we get started? Of course, this is a moment many of us have been waiting for. This is our policy panel in the annual research conference, and the theme for this policy panel is a theme that is going to resonate with all of us, of course: monetary policy challenges in a global economy. Now, as we all know, in recent years, the global economy has been going through
NASDAQ market is dropping.
Inflationary episode. Pretty much every country, everywhere, with a few exceptions, have seen inflation rates that they had not seen in many decades.
Can you guys hear okay?
Accompanied by a number of additional shocks as well. War on the European continent, an energy crisis, rising trade, geopolitical tensions, and of course, in response to this surge in inflation, central banks in many places have tightened monetary policy, also to an unprecedented degree in a long time, including in the US, but in many other places as well. Now, the good news is inflation is on a downward path in many places, even though it remains still quite high and above desired levels. And many central banks now appear to be near or at the peak of their hiking cycles, so they're communicated about that. So while we're not home yet, is an important time to take stock. And this panel will aim to shed some light on the trade-offs and the challenges that policymakers face today. Has the monetary policy response been sufficient? Has it been effective? What can we say about spillovers? And more broadly, is the central bank toolkit fit for the task at the current juncture? Now, to help us think about some of these very complicated issues, we have a really phenomenal panel today. I really cannot think of a set of people who would be more qualified to share their views on these questions. So I'm going to introduce them briefly in the order in which they will speak. We'll start first with Jay Powell. We're very fortunate to have Jay with us. Jay is chairman of the Federal Reserve System since 2018. Arguably, many would say, the most powerful policymaker in the world. He served as a member of the Board of Governors since 2012. Prior to the Federal Reserve Board, Jay worked in investment banking. He also served as Undersecretary of Treasury for Domestic Finance in the George W. Bush, H. Bush administration. Amir Yaron has been governor of the Bank of Israel since 2018. That is for almost as long as Jay's tenure as chairman of the Fed. Before that, Amir was professor of banking and finance at the Wharton School of Business at the University of Pennsylvania. And he's a world-renowned expert in macroeconomics, monetary economics, finance, and financial economics. And we're particularly delighted to have Amir with us today. Geeta Gopinath requires no introductions, I think, especially in these walls, but she is the first deputy managing director of the International Monetary Fund. Previously, Geeta had my job as chief economist and head of the research department. And prior to joining the IMF, she was the John Swanstra Professor of International Studies and of Economics at Harvard Universities, with a world-class record of research on exchange rates, trade and investment, international financial crisis, monetary policy, debt, emerging market crisis, a very long and distinguished list. And then last but obviously not least, Ken Rogoff. Ken is the motivation for this year's annual research conference in his honor. And we're very happy to have him today and tomorrow. And currently, the Moritz Boas Professor at Harvard University, also a former chief economist at the IMF in 2001, 2003. Another turbulent time for the global economy. Ken has written several extremely influential books and, of course, many research articles on debt and financial crisis. He has written what remains to this day a reference textbook, graduate textbook in
approaching
international
yesterday's
macroeconomics
highs
with Ken Rogoff in 1996. Is known for, with Maury Upseld in 1996, is known for his pioneering work on exchange rates, central bank independence, sovereign debt, financial crisis, among many other topics. And Ken has long ranked among the most cited economists. I checked quickly, and I think his RIPEC ranking, which is something us academics or former academics, we check carefully very often. I think his RIPEC ranking is number 11, which is totally astonishing. And his Google Scholar count is, off the charts, astronomical. And for those of you who don't know, I have to all mention this, Ken is also an international chess grandmaster. Now, we will start with short interventions from each of the panelists for about 10-12 minutes, followed by a quick discussion between them, and then we will open for discussion with the audience. There are mics in the aisles. If you're at the point at which we reached that stage in the panel, if you want to ask a question, please line up behind the mics, and then you will have a chance to do that. I will only ask that, since our time is counted, that you keep your questions brief, and you also keep them focused on the topic of the panel, which is monetary policy challenges for the global economy. Now with this, let's start with Jay. I believe Jay will talk about the nature of the inflation process in the US and the appropriateness of the monetary policy response. It's up to you, Jay.
Thank you very much, Pierre-Olivier. It's great to be here, particularly in honor of Ken, whom we're proud to count as a member of the Fed family. So my assigned topic is U.S. monetary policy in the current global inflation episode. So I'll begin by briefly addressing the U.S. outlook, and then I'll turn to three broader questions raised by the historic events of the pandemic era. So to begin, U.S. inflation has come down over the past year, but remains well above our 2% target. My colleagues and I are, of course, gratified by this progress, but we expect that the process of getting inflation sustainably down to 2% has a long way to go. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we expect growth to moderate in coming quarters. Of course,
Jerome Powell, by refusing to treat climate change like a systemic
Oh my goodness.
Thank you very much.
disaster.
Thank you very much.
Climate change
Yep.
will
How do they always let these people in?
Just close the fucking door. Close the door.
Oh! Did you guys hear that? Was it just me that heard that? They closed the stream. These protesters, what do they think they're gonna do? Nothing. Nothing. Oh my goodness. They just dropped the F-bomb, and now, why ruin it? It is no good for nothing. They have nothing better to do. Oh my goodness. Dude, how do they let these people in? Like, we all know that Jerome Powell, right? They said it. He's one of the most powerful people when it comes down to monetary policy. How is it that they even allow these people in the same room? Like, you're telling me that I can just go in there and throw a tomato at one of the most powerful individuals, not just in the United States, but possibly in the world? Insane. Like, how do they even allow that? I don't get that. I mean, I'm no one compared to Jerome Powell, but if you try to come to my office, we have our doors locked, right? Oh my gosh. Is this thing really over? I still can't get over what that guy said. Wow. Yeah, close the effing door. I love it. I'm going to give it a couple of minutes. Maybe they'll return back. Take some time to maybe drag those nobodies out of the building. I don't know what the market's going to try to do. Oh, man. I couldn't tell you what I would do. Jerome Powell saying the F word was so passive aggressive. I really don't think it was him that said it, though. And the crazy part is I was filming him to post it on my Instagram, and I'm pretty sure it was just seconds after that it all happened. It was him. Was it? For those that are just tuning on in, Jerome Powell just started to speak in this annual press conference, and some protesters walked in about, what was it? Global warming or something about the environment. And then they closed down the live stream. So they came with their, whatever, banner, how they always do, and just try to protest. I don't know what they did, but it doesn't look like it's helping the market. So right now, market looks a little uncertain. NASDAQ market pulling on back. I was just sending out the update to my LPP team, making them aware that on the 5-minute time frame, it's very easy to see. We are testing yesterday's lows, right? So I decided to lock in profits on SQQQ, and I walked away with $15,560 on the day. And there it goes.
Climate issues are important.
And I left myself with my one lucky share.
But as I mentioned, we'll try to keep the questions on the topic for today.
There we go. All right, we're going back to schedule.
Challenges for the global economy. Thank you.
Okay, but if you guys want to tune on into tomorrow's live trading session or the next time the market's open, second link in the description down below. But let's see if they bring back Jerome Powell.
And yeah.
Jerome Powell's like, I ain't speaking up here again.
No, I don't. Hold on. Let me check. We might have to go too.
This guy's trying to whisper. He has a microphone. Wow, what a mess. Look at all those people. How do they walk in? How? They're in Washington, D.C. Oh, they're bringing him back. Here we go. All right, guys, hope that we're on your thumbs up. Don't forget to subscribe, and I hope that you guys enjoy this.
Okay, where was I? Inflation was coming down. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we do expect growth to moderate in coming quarters. Of course, that remains to be seen, and we are attentive to the risk that stronger growth could undermine further progress in restoring balance to the labor market and in bringing inflation down, which could warrant a response from monetary policy. The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. We know that ongoing progress toward our 2% goal is not assured.
A script? This is all the same thing?
A few head fakes along the way. If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening. We're making decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity, inflation as well as the balance of risks, as we determine the extent of additional policy firming that may be appropriate to return inflation to 2% over time. And we'll keep at it until the job is done. So with that, let me turn to the three questions that I posed that have arisen from the receding but still elevated inflation we're experiencing today. The first question is, with the benefit of 2.5 years to look back, what we can say about the initial causes and ongoing policy implications of the current inflation. After running below our 2% target over the first year of the pandemic, core PCE inflation rose sharply in March 21. Economic forecasters generally did not see this coming, as shown by the February 21 survey of professional forecasters, which showed core PCE running at or below target over the subsequent 3 years. So the real-time policy questions for policymakers were what caused the high inflation and how policy should react. And at the outset, many forecasters and analysts, including FOMC participants, viewed the sudden upturn in inflation as mostly a function of pandemic-related shifts in the composition of demand, a disruption of supply chains, and a sharp decline in labor supply. The resulting supply and demand imbalances led to large increases in the prices of a range of items most directly affected by the pandemic, especially goods. In this view, as the pandemic abated, our dynamic and flexible economy was likely to adapt fairly quickly. Supply disruptions and shortages would diminish, labor supply would rebound, aided by the arrival of vaccines and the reopening of schools, elevated demand for goods would shift back to services, inflation would ease reasonably quickly without the need for significant policy response. Indeed, although monthly core PCE inflation spiked in March and April of 21, beginning in May, it declined for 5 consecutive months, providing some support for this view. But, of course, in the fourth quarter of 21, the data clearly changed amid waves of new COVID-19 variants, with only gradual process in restoring global supply chains and relatively few workers rejoining the labor force. That lack of progress, combined with very strong demand from households, contributed to a tight economy and a historically tight labor market, and more persistent high inflation. The committee signaled a change in our policy approach and financial conditions began to tighten. Of course, a new shock arrived in February of 22 when Russia invaded Ukraine, driving up prices of energy and other commodity prices. By the time we lifted off in March, it was clear that bringing down inflation would depend both on the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allow supply time to catch up. Today, these two processes are working together to bring inflation down. The FOMC has raised the federal funds rate target by 5.25 percentage points.
Congrats,
and
Maven.
we've reduced our securities holdings by more than $1 trillion. Monetary policy is in restrictive territory and putting downward pressure on demand and inflation. The unwinding of pandemic-related supply and demand distortions is playing an important role in the decline in inflation. For example, wage growth has steadily fallen since mid-2022 by most measures, despite continued robust job gains, reflecting a resurgence in labor supply, thanks both to higher labor force participation and a return of immigration to pre-pandemic levels. While the broader supply recovery continues, it's not clear how much more will be achieved by additional supply-side improvements. Going forward, it may be that a greater share of the progress in reducing inflation will have to come from tight monetary policy, restraining the growth of aggregate demand. Turning then to my second question. For many years, it has generally been thought that monetary policy should limit its response to or look through supply shocks to the extent that they are expected to be temporary and idiosyncratic. Many argue as well that in the future, supply disruptions are likely to be more frequent or more persistent than in the decades just before the pandemic. A second question then is what we've learned about this standard looking through approach. The idea that the response to the inflationary effects of supply shocks should be attenuated arises in part from the trade-off presented by those shocks. Supply shocks tend to move prices and employment in opposite directions, whereas monetary policy pushes each in the same direction. Therefore, the response of monetary policy to higher prices stemming from an adverse supply shock should be attenuated because it would otherwise amplify the unwanted decline in employment. In addition, supply shocks have most frequently come from the volatile food and energy categories, and they've passed through quickly. While food and energy prices critically affect the budgets of households and businesses, the policy tools of central banks work more slowly than commodity markets move. So responding aggressively to quickly passing price increases could exacerbate macroeconomic volatility without supporting price stability. Our experience since 2020 highlights some limits of this thinking. To begin with, it can be challenging to disentangle supply shocks from demand shocks in real time, and also to determine how long either will persist, particularly in the extraordinary circumstances of the past 3 years. Supply shocks that have a persistent effect on potential output could call for restrictive policy to better align aggregate demand with the suppressed level of aggregate supply. The sequence of shocks to global supply chains experienced from 2020 to 22 suppressed output for a considerable time and actually may have persistently altered global supply dynamics. Such a sequence calls on policymakers to use policy restraint to limit inflationary effects. Policy restraint in this case is also good risk management. Supply shocks that drive inflation high enough for long enough can affect the longer-term inflation expectations of households and businesses. Monetary policy must forthrightly address any risks of a potential de-anchoring of inflation expectations, as well-anchored expectations help bring inflation back to our target. The sharp policy tightening during 2022 likely contributed to keeping inflation expectations well anchored. My third question, then, is the level where interest rates will settle once the effects of the pandemic are truly behind us. By 2019, the general level of nominal interest rates had declined steadily over several decades. As the pandemic arrived, many advanced economies had below target inflation and low or mildly negative rates, raising difficult questions about the efficacy of interest rate policy when constrained by the effective lower bound, or the ELB, as we call it. Over 2 decades, an extensive literature had identified a number of possible changes to the widely used inflation targeting regime, including negative policy rates, nominal income targeting, and various forms of makeup strategies, under which persistent shortfalls in inflation would be followed by a period of inflation running moderately above 2%. Today, inflation and policy rates are elevated, and the effective lower bound is not currently relevant for our policy decisions. But it's far too soon to say whether the monetary policy challenges of the ELB will ultimately turn out to be a thing of the past. The prolonged proximity of interest rates to the ELB was at the heart of the monetary policy review and the changes we made to our framework in 2020. We will begin our next 5-year review in the latter half of 2024 and announce the results about a year later. Among the questions we will consider is the degree to which the structural features of the economy that led to low interest rates in the pre-pandemic period will persist. With time, we will continue to learn from the experience of the past few years and what implications it may hold for monetary policy. These are just 3 of the many questions raised by these challenging times, and of course, we're very far from a complete understanding of the answers. Again, it's great to be here today, and I look forward to our conversation. Thank you.
Thank you very much, Jay, and I think we're really off to an excellent start with your remarks. Let me now
Great start.
turn to Amir. Amir, Israel is a small open economy, faces very specific challenges. Like the US and many other countries, it's seen an increase in inflation in recent years, and the Bank of Israel has been acting on it. In addition, like other small open economies, it faces potential spillovers from monetary policy decisions taken elsewhere.
NASDAQ market picking up.
With a potential impact on currency and capital flows, and we'd love to hear your views. So, Amir, the floor is yours.
All right. First, it's a pleasure to be here in a conference in honor of Ken Rogoff. We all cherish and follow his distinguished contribution in academia and practice.
Bank of Israel.
Interesting. In a short term, as we're all aware, Israel is currently at a war following the October 7th inhuman brutal attack by the terrorist organization of Hamas. This is a crucial time for Israel's security, and we thank all those who support us. Our hearts are with the innocent victims of the war, and our hope is for it to end with the safe return of hostages and with peace and security. And now I'm going to turn now. I want to turn now to address the issues and questions presented for this session. An important question is, to what extent can a small open economy like Israel, or for that matter, any SOE, conduct its monetary policy independently?
Getting rejected.
Follow the steps of the major economies. Another question is, what are the spillovers from the policy taken by the major economies to small open economies, and how do those impact local conditions? The answer to these questions depends on the development of the economy, its specific areas of exposure to the global.
So for those that are unaware, there's 4 individuals that are speaking about their own versions of monetary policy. They're pretty much giving speeches. They called it questions, but it almost just sounds like a speech. And Jerome Powell has already gone. Unless Jerome Powell, after all 4 individuals give their introduction speech, begins to answer some questions, I can't really imagine what these people might say to influence our markets too much. Obviously, it is important, especially if something very conflicting is said. But our guy, Jerome Powell, said what he needed to say. And I just don't know if it's going to be worth our time to watch this live stream from these other individuals that have a lot less influence to our market. Do you get what I mean? I can provide you guys the link. So if you guys want to watch this stream yourself, I'm going to provide it for you. I always, again, encourage you to try to stay as informed as possible. But I know for myself, I mean, I took my trade on TQQQ. I called it out for the LPP team. It was very oversold. I like the reversal. I actually cut losses on my secondary trade on SQQQ, and then I added back to it once we got more confirmation. It was much easier to see on the 5-minute time frame once we actually began to show signs of progress of higher highs and higher lows. And then right before this speech, we saw the NASDAQ market really begin to sell off, which meant that SQQQ really began to take off. And then I ended up blocking in profit. So I walked away with 15,500 on the day, and I left myself with my 1 lucky share. I just opened a position on TQQQ just in case we do see a break of pattern, right? The overall NASDAQ market has been more bullish than it has been bearish, right? But it looks like we might be finally breaking below this EMA line. So I have no intention of being aggressive with my TQQQ trade. I can quickly cut losses on it just so you could see. I just wanted to see, just in case there was a chance for this thing to rally, I was going to buy a few thousand shares and try to make a couple of bucks and then sell close to the moving average. But again, I'm not in need for this thing to go up. I saw the potential opportunity for me, and it was testing the EMA. We'll see if we show signs of progress, and if it begins to make lower lows and lower highs, then my job's not to be perfect. I'm never going to be perfect. I make mistakes, but that's the beautiful thing about trading, is that it's not about making mistakes, but how quickly you identify them, right? And it's always so much easier, at least in my experience. This is why we share it with our Learn Plan Profit team. And feel free to share your thoughts, but it's always so much easier to manage and mitigate risk when your position size isn't too big, right? It allows you to stay effective, doesn't overwhelm you with emotion. And that's why I only purchased 1,000 shares, as you can see here, for TQQQ. Keeping it light, keeping it tight. There's definitely potential for this thing to recover, as the market's been relentless for the past week and a half, but we'll see, right? There's no reason to overcomplicate it. I'm going to keep it simple, and then we can go from there. So, alrighty. Is there any last minute questions that I could answer for you guys? 8 times the volume when he gets closer to the mic. Great trade today, Ricky. Thank you. Like this video up, people. I appreciate that. Thank you guys again for your time. I do want to remind you that I think they're observing it tomorrow, but I don't believe the stock market is closed in observance to Veterans Day, because I think they're actually celebrating it on Saturday. I just looked it up, and according to the NASDAQ holiday calendar, Tomorrow for Veterans Day, it's not recorded as the stock market being closed. So I'll be live. I'll be live right at market open. So if you like what you saw today, where you can see my entries and my exits, this is something that I do every single day. You get to see, again, it's not just good trades. You get to see bad trades. I make mistakes all the time. But the really cool thing about that is, like, when do you get to see someone enter and exit a trade, good and bad? And you get to see this every single day, especially as you're just getting started, right? So if you'd like to experience it, again, I trade live every single day right at market open, and I do it with one team and one team only, and that is my Learn Plan Profit team. So if you want to check that out, you don't have to, but if you would, it's the second link in the description down below. It's a one-time payment, lifetime access. And again, I work with them every single day, and I like to keep things simple. So I appreciate your time. Hope that we're in a thumbs up. Don't forget to subscribe. Next week is the CPI data report, which is a very significant report. It's an inflation report that will determine if the Federal Reserve raises rates again or if they remain dovish, right, and continue to pause. So I'd be more than happy to welcome you to that live stream, and all you have to do is subscribe. So I hope that earned your thumbs up. And like always, let's make sure that we end the year on a green note.